Welcome to EconTalk, part of the Library of Economics and Liberty. I'm your host, Russ Roberts of Stanford University's Hoover Institution. Our website is econtalk.org, where you can subscribe, comment on this podcast, and find links and other information related to today's conversation. You'll also find our archives, where you can listen to every episode we've ever done going back to 2006. Our email address is mail@econtalk.org. We'd love to hear from you. Today is October 19th, 2012, and my guest is Steve Hanke of Johns Hopkins University and the Cato Institute. Steve, welcome to EconTalk.
Thank you, Russ. Great to be with you.
Now, our topic for today is hyperinflation. What is hyperinflation?
Well, traditionally, it's been defined as any rate of price increase that exceeds 50% in 1 month. And the person who did the work and eventually defined it was Professor Philip Kagan, who was at Columbia, and that's the origin of the 50%. And since then, it's been traditionally used by everyone who's studying hyperinflation.
And historically, some famous hyperinflations would include the Weimar Republic in Germany, right, in the 20s, right?
Yes, that one actually peaked out in October of 1923, but it was only the fifth highest one in the world, and it was much below the big high ones above it.
What are some of those?
It peaked out in October of 1923. This is a Weimar at 29,500%. In 1 month. Now that's an awfully big number.
Seems like it.
But if then we jump up to number 3, and by the way, there are 57 countries that have had hyperinflation, Russ. But if we jump up to number 3, that was Yugoslavia in January of 1994, and that one was 313 million%. So we're going Germany 29,500 up to 13.3 million. In Zimbabwe, in mid-November, that one peaked out, mid-November of 2008, it peaked out at 79 billion% in a month. And then Hungary is got the number one spot, July 1946. And I'm not going to give you all the zeros, but that one peaked out at a daily equivalent rate of 207% in a day.
Well, now it's hard to relate to those numbers, but when we
it's very hard to relate. That's one, this piece that I did with one of my assistants, Nick Cruz. We listed all 57. We've documented now all known. Some weren't known until we did this piece. It'll eventually be appearing as a chapter in a book. Right now, it's a Cato working paper. But to get your head around the numbers, the monthly rates get so high that the best way to do it is to translate them into daily equivalent rates, and then another thing that we've done is have a metric for the time required for prices to double. So in Hungary, that huge inflation, that's number one, the prices were doubling in 15 hours. Zimbabwe, 27.4 hours, Yugoslavia, 1.4 days, and so forth. So of those, the thing that it kind of intrigues me about it, and the reason I kept pushing ahead with this research, which was kind of onerous, basically, trying to get all the metrics organized and find all the cases and actually come across some cases that have never been reported before. Out of the 57 cases, I've been involved either directly or closely with the stopping of 10 of the 57. So, as they say, I've got some experience with stopping these.
So before we get to that, though, let's talk about how I actually want to just talk first about the logistics. When prices are doubling every 15 hours, I mean, is that really a meaningful phenomenon in terms of trying to measure it? And people, if you're actually making transactions at those prices, you're getting up early to, I mean, every second you're losing money that you can't scratch your ankle on the way to the store.
Well, yeah, it actually is meaningful in the sense that the unit of account that you're using isn't the hyperinflating currency. The unit of account you're really using is some solid currency, like it could be gold. It was gold in Greece, for example, or now it's typically the U.S. dollar. So anything that a merchant wants to sell you, they will first think in terms of how much in dollars, and then they'll translate. Usually they'll get on their cell phone and ask a dealer what the rate is for whatever the local currency is vis-a-vis the dollar. And if you've got local money, they'll charge you that, or maybe they'll charge you that plus a premium because they're going to have to run down to a money changer and change it.
Right.
And the time, depending on how fast they are, will be the premium that they charge you.
But if there is no available, obvious alternative to the local currency that's having that problem, pretty quickly the economic system breaks down and you're in a barter economy, right?
Well, you do have a lot of barter. Let me give you the Yugoslav case because I was there. I was a advisor to the Markovic government. Now this was before the hyperinflation, but right before. It was in 1990 until the middle of 1991, and the barter was occurring, and what you would do, you had relatives that were, in most cases, let's say you were in Belgrade, you would have all your relatives out in the country would be supplying you really with foodstuffs, and other transactions in Yugoslavia were always taking place in Deutschmarks anyway. Any significant purchase required Deutschmarks, and the reason why is that they'd had endemic, very high inflation in Yugoslavia. From 1971 until 91, the average annual rate of inflation was 76%. It was the second highest average annual rate over that 20-year period that was recorded. Zaire was number one. So the economy, in a hyperinflation or even a very high inflation, what happens? Yes, there's a lot of barter that starts seeping into the system, and basically the hyperinflation throws a monkey wrench into the economic system because you can't calculate costs properly and so forth.
Right.
It becomes very cumbersome. But the other thing that happens is that foreign currencies start being substituted for the local currency.
Because people don't want barter.
You get currency substitution taking place, and in a place like Zimbabwe, for example, what happened with that hyperinflation is that eventually people just stopped using the Zimbabwe dollar in November of 2008. It came to an end, and there was spontaneous dollarization that took place where the U.S. dollar and to some extent the South African rand and a few other currencies from borderline countries crept in, and the Zimbabwe dollar just wasn't used for anything.
Right.
And the next step was that the government was forced then to officially dollarize the country and change the budget and require taxes and so forth to be paid in dollars. So the Zimbabwe dollar is gone now, and Zimbabwe is officially dollarized.
So the $1 trillion Zimbabwe note that one of my students sent me, you're saying that's worthless now? I'm very disappointed.
Well, no, on eBay it has a lot more value than it ever did when it was circulating.
So this is a softball question. What causes hyperinflation? But there's a harder question behind that. Obviously, what causes it is a rapid increase in the money supply. But why?
Very rapid increase in the money supply, and you get this. See, you get back to the ultimately. Well, what causes the money supply to explode?
Why would a nation
usually
do that?
That's the fiscal situation. And in Yugoslavia, for example, at the end, about 90% of all the government expenditures were being financed by the printing press, by the central bank. In other words, taxes that they were receiving were only about 10% of the total amount of expenditures. So the budget deficit, in short, was running about 90%.
And so rather than cut expenditures or raise taxes, neither of which was politically appealing, they just printed the money and punished their students.
They just printed the money, yeah.
They taxed people through this process we're talking about. They devalued any currency that people were holding and made their lives less pleasant.
Right.
So we're going to talk about Iran in a few minutes, but before we do that, let's talk about the United States, which we're not having hyperinflation, but we do have a fiscal problem. We do have we're spending a relatively large amount relative to what we take in, about $1 trillion more than we take in, a little over $1 trillion. We've done it for 4 years in a row. We did it before that at a significant amount as well. And people keep buying our bonds, and so it seems okay. But one of the institutions that's buying those bonds is the Federal Reserve. I've read that a very large portion of U.S. Treasury auctions are being purchased by the Federal Reserve. Can you explain that?
It's been about since they started the so-called quantitative easing, I think roughly since the Lehman collapse in September of 2008, I think it's about 75%.
Right.
Of the total is being purchased by the Fed.
So can you explain to me what that means and what it portends for the future?
Well, let's just start with Lehman's collapse in September of 2008. That's a convenient date. Since that point in time, the Federal Reserve's balance sheet has increased by roughly about 3.5 times. So that means they're buying a lot of these bonds, and that's where they go on the asset side of the balance sheet. Now, that means that high-powered money, or what I call state money, the amount of money produced by the state is more or less tripled, has just exploded, and this has many people concerned, and they get excited and say we're going to have hyperinflation tomorrow. That's a hyperinflation nexus.
Yeah,
so the Fed's buying all these bonds. Their balance sheets exploding. The high-powered money is increased very rapidly, and people conclude that, well, this is going to be like Yugoslavia or the Weimar Republic or something like that. Now, it has meant that state money, Russ, has increased from about 6.5% of the total money supply when you measure the money supply properly with a broad measure like M3. So we went from state money being 6.5% at about the time Lehman collapsed until now it's about 15%. So, you've more than doubled the size of state money. But the problem is, I said 15%. Now state money is 15% of the total amount of the money supply, meaning that state money is peanuts. What really is important is bank money. And bank money is created by the commercial banking system and shadow banking system, and that's what really counts. So in a way, we have had the following scenario develop after Lehman. We've had ultra loose monetary policy with regard to state money in the Federal Reserve, but with the financial regulation that it was legislated with Dodd-Frank and also with what's called the Basel capital requirements, and specifically Basel III, which is being imposed on banks to increase the capital asset ratios of the banks. These two things, financial regulation and Basel have, in effect, imposed ultra-tight monetary policy on the banking system and bank money. So as a result of the two, we've had the total amount of the money supply actually being very anemic, not growing very much at all. And in fact, if you look at a trend line since 1999, since 2009, and look at the end point today of the trend line as you're going left to right, that point is about 7.5% higher than the actual level of the money supply that we have. So you could argue there's, relative to trend, we've got a deficiency of about 7.5% in broad money. And the reason why is that the dominating feature has been the re-regulation of banks and the tight monetary policy imposed on bank money, which accounts for 85% of the total amount of money in the economy.
So that's consistent with Scott Sumner's view, who argues that monetary policy has been very tight rather than loose. Everyone looks at the aggressive, so-called aggressive policy of the Fed. But my question then is, you're saying that banks have been highly regulated, and you can also argue that the economic situation is not very optimistic right now. It's kind of uncertain. But banks have huge excess reserves. So you're saying they're constrained, but it appears they're very unconstrained. Why aren't they?
Oh, no, they're profit maximizing. Banks are profit maximizing. So what happens is if you are imposing capital requirements on banks vis-a-vis Basel III, and you're requiring the capital to asset ratio of a bank to go up, how do you change that ratio? Well, one way to do it is to raise capital and increase the numerator in the capital asset ratio. The problem with that is that the price of shares for banks now is much below the book value of the shares, and if you actually issue more shares and try to raise capital, you're diluting the existing shareholders when you have those conditions existing, and so the existing shareholders don't want to raise more capital. So what you try to do is reduce the assets that you have, and specifically, you want to reduce what's called the risk assets, those that come under the umbrella of Basel III, that require a certain
high
amount
ratio
of capital to be set aside against them. So here's what we've had since Lehman. We've had loans to commercial enterprises have gone down in the United States. Mortgages have gone down in the United States. Interbank lending has essentially disappeared, which is almost the lifeblood of the banking system, is the interbank. So what's gone up? Because the total amount of the assets that banks have, the consolidated system has gone up. So what's gone up? Well, one thing that's gone up, government bonds, because government bonds are deemed to be risk-free by Basel. You don't have to set aside any capital to buy government bonds. So government bonds have exploded, the holding of government bonds. The other thing that's exploded are, you mentioned excess reserves. Well, you've got cash. Cash has gone way up. So banks find it profitable to avoid the Basel regulations in effect by accumulating government bonds and cash, and they make money at it because there's a yield spread between the amount they're getting on the cash and the amount that they're having to pay for the money they've borrowed to go into cash or go into excess reserves. I mean, now excess reserves at the Fed are actually receiving interest.
Yeah, so I've always been puzzled by this, so maybe you can help me. The story you've just told is that banks have rationally responded to the incentives of regulation and the Fed offering reserves to accumulate large excess reserves rather than issue more stock, rather than raise more money. As a result, or maybe I'm getting the narrative wrong, but at the same time, at least, the money supply is limping along, not exploding, despite the high balance sheet of the increased balance sheet of the Fed. So Ben Bernanke knows all this. He knows all these facts. They're not secrets. You and I aren't the only people, and the listeners of EconTalk that know that M3 is actually down, not up. What the heck are they doing? What's your guess as to what the heck they're thinking?
Well, the big problem is in economic lingo is that what we've been talking about and what I've been talking as a monetarist, an old-fashioned monetarist, and in particular a broad money monetarist. Broad money counts, and it's the thing that dominates the economic picture.
Broad meaning including bank money and not just state money, not just reserves.
Right. State money and as well as bank money, and ending up with something. I mean, the best measure really we have is what Professor Burnett has been producing, and that's the Divisia M4. That's the broadest measure, and the measure that's measured correctly, and so forth, and that's been lagging behind. Now it's picking up just a little bit, but that measure is only growing at about a 4.5% per annum rate. I should say year over year. The year-over-year rate of growth is still very, very slow in this broad measure, and it's now relatively high compared to where it was a year or two ago.
But just to put it in perspective,
back to Bernanke.
Yeah, hang on.
Go ahead.
Let me re-enter you back into the issue of Bernanke in a different way.
Yeah.
He famously said, "We'll never let." This is before he was chair of the Fed, right? I think at a conference with Milton Friedman, he famously said, "We've learned our lesson from the Depression when we let the money supply drop, right? Because bank money shrank during the Great Depression dramatically, right? We had all these closures, and we had a contraction of lending. And by bank money, you mean all the liquidity that banks produce through their lending based on those reserves that they hold at the Fed. And so he said, we'll never let that happen again. And what you're saying is he let it happen again.
Oh, he absolutely doesn't have. I think he's probably one of the worst chairmen we've ever had at the Fed, and he's strictly not a monetarist. There's no question about it. He's an inflation targeter. He's made his reputation as an inflation targeter, and as long as they're hitting that target. And now let us say it's in the 0 to 2% range. Right. Although one of the Fed governors, a president of regional Fed, Evans, has indicated that maybe 3% would be an appropriate acceptable top level. And we can get into that if we want to get out in those weeds a little bit later.
I don't. Go ahead. Keep going.
But at any rate, the bottom line is that Bernanke is not a monetarist, and he's certainly not a supply sider. He doesn't have a supply side orientation on monetary policy. And the supply siders, you see, they like to look at prices, not quantities. So unlike a monetarist who would want to be looking at the quantity of money, they would be keeping their eye on prices. Now, what do I mean by that? That means foreign exchange rates, the yield curve, the gold, maybe a basket of primary commodities of 20 or 25 commodities. They'd be looking at things like that, and asset prices, the stock market, as well as commodity prices, as well as foreign exchange, as well as interest rate and the yield curve. That would be kind of a supply side type of approach. The monetarist would be looking at the quantity of money mainly. I'm actually looking at both, to tell you the truth. But whereas Bernanke, he doesn't even have those prices on his dashboard. If you look at what he's looking at, it doesn't include the dollar exchange rate. the critical thing, the dollar exchange rate, the price of gold. Those are, he claims he's not looking at those.
So with the benefit of hindsight, what should he have done? Given that you're arguing that he's let M3 or M4, these broad measures of liquidity in the economy, shrink, that's had a real impact on the economy. It's slowed the recovery. It's made it anemic. What could he or should he have done? A lot of people have faulted him for being way too aggressive. You're saying he wasn't aggressive enough. How could he have implemented a policy to make up for the shrinkage in bank money?
Well, he could have come out against the Dodd-Frank financial legislation. That would have been maybe a politically dangerous thing to do, going head-to-head with Congress. But the other thing he could have done,
and you mentioned that,
put a freeze on Basel. Basel, he has a direct input into the capital requirements of banks. But you see that the reason the Americans love Basel III is that the European banks that the American banks are competing with in the international market, they're relatively undercapitalized compared to the American banks. So basically, by imposing Basel III, you're saying you're mandating, you have a government mandate that says that the European banks have to shrink faster than the American ones.
Mm. Lovely. How did the European banks fail to get that fixed? They knew that too, right?
Well,
is this an unintended consequence?
The origin of this is interesting. My diagnosis of the thing is that there was the crisis really started in August of 2007, and it happened in Europe and the UK in particular. There was a bank called Northern Rock.
Yep.
Northern Rock was a mortgage institution. It was solvent at the time, and it was very profitable. And their funding source for the mortgage, they would lend long with a long-term mortgage, but the funding sources, they were using the money market funds issued in France. And in August, two of these froze up. Two of these French money market funds froze up, and so the Northern Rock people went to the Bank of England and they said, we need a lender of last resort. We're solvent. We're willing to pay whatever the penalty rate is and borrow from the Bank of England. King, who was still is the head of the Bank of England, was fine. Everything was fine, and they arranged to do this. But there was one little catch, and that is there was a reporter from the BBC that was friendly with somebody working at the Bank of England, and the chap at the Bank of England leaked the information that Northern Rock was going to get a substantial lender of last resort loan from the Bank of England, and that was reported by the BBC. Well, what happened then? The depositors, of course, panicked because they said, "Oh, it's obvious that the Northern Rock is bust, and they've had to go to the Bank of England, and we want our money back." So you had the first bank run in 100 years in the UK, and that really burnt the politicians. At the time, Gordon Brown was a prime minister, and Darling was the Chancellor of the Exchequer, and of course they ended up having to foot the bill for Northern Rock, ultimately going under, which was a big bill because of this bank run business.
I thought they were solvent.
They were solvent, but what if you what if every depositor comes in and they want their money today?
Well, if they're solvent, they have the assets to cover it. So
you got a liquidity problem. You have to liquidate everything that you have to pay everybody off. And even though on paper it looks like you're solvent, and you have good paper and you've got a profitable operation, you're forced to cough up the money.
Yeah, I don't understand that, but we can come back to that or maybe skip it because in theory.
So at any rate,
it's
a liquidity thing. They needed to come up with the money.
So
they needed to liquefy their asset side of their balance sheet in a matter of a few days, and the only way they could do that is to have the government come in and bail them out.
Well, okay.
To pay the depositors off, and as a result of this, of course, there was a political price, and as I say, Gordon Brown got burnt. He was holding the bill, and the taxpayers were upset because they had to pay the depositors off that had wanted their money back from Northern Rock. And he led then this campaign to recapitalize banks every place, and it became kind of an international mantra, and everybody, the herd followed, and that's where the Basel thing accelerated and got going. And then in the United States, it came, and Secretary Geithner is a big advocate of recapitalizing banks. Part of it is really not is a little bit disingenuous because it's advantageous to the U.S. as relative to areas of Europe where they're undercapitalized and have a big gap to make up to get back to Basel III.
By capitalize, you mean have a lower rate of leverage, meaning having a larger asset base rather than a borrowed money to finance your operations, correct?
Well, not asset base, capital base, equity.
Equity.
You got to increase. The equity is, remember, on the right hand side of the balance sheet. So you got to have a bigger equity and less borrowing on that right hand side, and on the left hand side, that's where the assets are. And of course, you can increase your capital asset ratio very quickly by just dumping assets and not raising any more capital, and that's more or less what's been going on, because it's so unattractive to raise capital now due to the fact that share prices are below book value for most banks.
But the argument for this recapitalization is that if banks have more equity and less borrowing, they have a bigger cushion. If their asset values fall,
right.
That's the argument of Basel.
That's the idea, and that comes back. What you said about leverage is exactly right. I mean, it forces you to have less leverage than would be the case if you had a lower capital asset ratio.
So let's come back to this issue of the risk of inflation of a sizable amount in the United States. So I'm going to review how we got to where we are in the conversation. You argued convincingly to me, but then again, I'm a monetarist. But you argued that although high-powered money, state money, you call it, reserves of the Fed, at the Fed, all that's grown dramatically. It's more than doubled since 2008. But there was
more than tripled.
But there was a shrinkage of lending and other liquidity in the private sector, what you call bank money, so that the total money supply, the total amount of liquidity sloshing around the economy has fallen. And as a result, our economy is hesitating, and hyperinflation is the last thing we have to worry about, despite the massive activity of the Fed. What Alan Meltzer would argue, and has argued on this program, and I don't know if he'd still argue, it was a few years ago, but his argument was, well, yeah, but eventually, when banks get more optimistic about the future and the economy starts to recover, then all those excess reserves, instead of sitting on the balance sheet of the Fed, they're going to go out into the real economy, and there will be inflation. So that bank money that had shrunk during the bad times will start to expand, and then the pressure will be on the Fed to shrink back its state money, its printing press money, and that's going to be politically unpalatable, and we're going to get significant inflation. What do you think of that argument?
Well, Professor Meltzer and I have corresponded on this, and as we've agreed, we generally agree on almost everything except this point.
Okay, good. That's lively. I like that.
So, and it does put one in a very awkward position to actually be in disagreement with, shall we say, I think, the acknowledged dean of the Federal Reserve now.
That's right.
His 3-volume work on
Opus.
the Fed. I mean,
Yep.
So let's get down to why I don't agree. You made Professor Meltzer's argument. That's still his argument.
Okay.
My argument is, well, if things start unfolding and banks get more optimistic and they want to reduce the amount of cash they have and the amount of government bonds that they have and put it into commercial and industrial loans and mortgages and interbank lending and all these things, we will, in short, increase the level of the money multiplier in the system, so that high-powered money right now, the money multiplier that is associated with that high-powered money is, let's say, about 5 or 6, depending on what monetary aggregate you're looking at relative to high-powered money. But let's just say this more or less 5 or 6 relative to M3. And it was before the crisis. It was about 12.
Yep.
So the money multiplier is about half of what it used to be. And another way of looking at what Professor Meltzer is saying is that, well, he's worried about, once the money multiplier goes back to shall we say normal levels of 10 or something, that state money will kind of goose the system.
Yep.
It'll end up bleeding through the banking system, the fractional reserve system, and even if there was no change in the volume of state money circulating, that you would have a huge increase in bank money, because with the optimism, the money multiplier would go back up to a normal level, and bank money would increase, and therefore the broad measure of money would ultimately increase. And yes, you would definitely have, aggregate demand increasing and getting up to, some level. Let's say, in boom periods in the United States, the aggregate demand, the final sales to domestic purchasers, it gets up to 7.5% or 8%, something like that. And if growth is about 3%, long-term trend rate of growth about 3 or 3.1, 3.2, just subtract the 3.1 from the 7.5, and you've got inflation.
Yep.
So that is a concern, but the Fed should be able to realize the problem that they have gotten us into with this inflation targeting scenario, and the very low interest rates, big expansion of their balance sheet. I'm not saying that that's been a good policy, Russ, but the reality is that that's what they've done, and they will have to face the music under the Meltzer kind of scenario. And
he says they won't want to.
He
says they won't want to. Right? He says they won't want to. Politically, it'll be too unpleasant for the chair of the Fed to be called in front of Congress to ask why he's taking away the punch bowl before the party's even getting started.
Well, but that's always something that the Fed chairman faces, and I would say that in this case, they should put Bernanke on the hot seat for a number of things.
Yeah, well, I'm with you there. Let me take an implication of what you said I've asked many times on this program, which is why the Fed is paying reserves, interest on reserves. Are you suggesting the possibility then that the Fed is paying the interest on reserves to compensate the banks for the unpleasant compliance with Basel III? This is a way to soften the blow.
It allows them to make good money on risk-free assets, basically, and to, with these profits, to recapitalize themselves and increase the capital asset ratio, and it gets back to the Basel thing. I mean, it's a mechanism that allows the banks to do this. They're making very good money on so-called risk-free assets, at least as defined by Basel, are risk-free.
So the other day I was meeting with some people who were much savvier and much wealthier and wiser than I am, and they asked me about this issue. And they think the dollar, and they're not the only people I've met who believe this, they think the dollar is going to disappear. They think there's hyperinflation coming. You ought to be buying gold. We don't give financial advice on this program, so we're not talking about that. But I'm talking about their perspective. They think the dollar is cooked. That the long run, to go beyond the immediate today and tomorrow, but the fiscal situation in the United States, we're going to end up like Zimbabwe. We're going to have too many promises that we've made to public pensions and to Medicare and Social Security. The Fed's already buying up all of those government bonds. They're going to keep doing that. And ultimately, we're talking hyperinflation. The dollar's disappearing. So you're not that pessimistic. You're not as pessimistic as they are.
No, I don't. I mean, as far as gold goes, I like gold, and I'm not making any recommendation, but I've done so on various Bloomberg shows and so forth. But the problem is not going to be a Zimbabwe hyperinflation. I mean, if anything, the problem right now today is the fact that we have a deficiency in broad money for the reasons that I gave, mainly because we have imposed ultra tight monetary policy on bank money, and that's what all these people are just missing the picture. Basically, they're going on and on about state money, and the fact that state money is a portion of the total amount of the money supply has more than doubled since Lehman. But it's only 15% of the total.
Yeah, I like your point.
The big thing is bank money, and bank money is being crushed. And that's why overall my assessment is we have a little deficiency in the money supply. Not great like they do in the European monetary system, where you have places like Greece, the deficiency is about 45% of the gap between where I think they should be with the money supply if they had been following a trend rate of growth in the money supply and where the money supply actually is. You've got about a 45% gap. And all these countries in Europe that are really in trouble, the southern countries, they have huge monetary deficiencies. The only country in Europe that is on trend is Germany. All the other ones are running big deficiencies.
So let me ask a different concern that these folks had, which I also hear, which is we're going to end up like Greece. We can borrow money right now for some reason. One argument is we're the tallest pygmy. Everybody else has lousy. They're even worse. So people will still buy our bonds, but as our debt to GDP ratio continues to rise because of these fiscal issues, eventually people are going to stop buying our bonds. We're going to go bust, and we're going to end up printing money.
Don't get me wrong. I'm with them in the sense that now you're talking about something else. We kind of shifted from this hyperinflation thing to the fiscal situation.
I'm shifting.
And the fiscal situation is a very simple problem. We have a huge fiscal problem in the United States, and it bears some of the earmarks that you've just repeated. But the main thing here is that government expenditures relative to GDP are they're outside the range that we've observed in the United States since the end of World War II. They're very high.
Yep.
So the problem isn't not enough taxes. The problem is cutting government expenditures and getting government expenditures down in the zone again, getting that number down from 25% of GDP at the federal level to something like 22, for example.
Well, I agree with you philosophically, but why is that? What's holy or sanctified about 19 or 22, or what's the big deal? I agree with you that philosophically, 25% of government, I don't like what they spend it on. I don't see that that's a good allocation of resources. That's my ideological position, my philosophical position. I could try to make a case for it empirically, but why is it a crisis? What's wrong with? So it's 25. Big deal.
Well, here's the crisis. Once you get out of the zone that we've been in since World War II, no matter what political party, it's not really a partisan thing. In fact, the fiscally most prudent president we've had has been President Clinton.
Correct.
President Clinton actually reduced government expenditures as a percent of GDP over his 2-year term by 3.9%. Now, there's no other president that even comes close to that. And in the last 2 years Clinton was president, he actually was running a fiscal surplus. Remember the big deal in.
Sure. What's the Fed?
Big
What's
panic
the Treasury?
that the folks that you were talking with about what was going to happen with hyperinflation and the bonds, their big panic was there wouldn't be any government bonds.
Yeah.
There wouldn't be any 30-year paper left in the United States. And
I didn't understand
how would
that.
the economy run if you couldn't be trading 30 years, and the yield curve would disappear and so on. So here's the problem. There isn't anything magic about being, as you point out, about being in the zone, let's say, of around
20. Let's say 20.
More or less.
It's historical level,
something like that. The problem is that we're in a new regime now. We're up above that level that we've been at, the range. We're outside the range, and transitions and regime changes are a problem. It's a little bit like, they interviewed one of these guys that went down Niagara Falls in a barrel, and he survived and came out at the other end, and they said, "Well, sir, how was that ride?" And he said, "Well, it was pretty calm above the falls and below the falls, but the transition was a bitch." And that's the problem we have. We're in a transition now, and if we stay above, it's going to be this Niagara Falls kind of problem. There's no question about it. So we have to figure out whether we want to go down the falls and go through the transition, or whether we will dial back government expenditures and get it down in the range that we've been at historically. No matter what party, by the way.
Yeah, but why is it?
It has nothing to do with parties.
But
and so
why
on.
is it like going over Niagara Falls? We just borrow more money. What's the big deal?
Well, you raised a specter. If you're having to borrow $1 trillion a year, that's a lot of bread, as they say.
World capital market's pretty big.
The capital market's very big. We had absolutely no trouble doing this to date, and you can see it as reflected in the interest rates and the shape of the yield curve and all the rest of it in the United States. There has been no problem, but you can. The markets run on expectations, and if you expect this kind of borrowing, as far as the eye can see, and no dialing back on government expenditures or dramatic increases in taxes, eventually you'll have a problem with the markets.
You'd think so.
The markets will eventually see through it. They might not do it tomorrow, but eventually they will.
And then what would happen?
Well, in that case, interest rates would just simply go up.
Right.
Now you get a lot of squeezing out of private activity. Right now, you see the problem in the United States. They're complaining, your friends, about the specter of hyperinflation and all of the rest of it, and loose money. But the reality is we're in a credit crunch in the United States for the reasons that I've given. Money's very hard to get.
What's the evidence for that it's hard to get? I've heard that as well, and I hear it's
true.
Well,
you look at the Federal Reserve System. They survey businesses, and private individuals and the so-called non-bank public, and you look at the surveys that they do, and you don't have to be a rocket scientist to figure out that people want to borrow money and find it difficult to get it,
despite the fact that it's everywhere, supposedly. Right, there's all this money in the system, but you can't get it. It's a paradox.
This is. Let's look at mortgages just to get it down to ground level. Mortgage rates are at record low levels, but the problem is getting one, because you have to meet standards. There's non-price rationing going on, to use economic jargon, and the standards required to obtain a mortgage and a loan are simply higher and more onerous than they've been in the past, and that's how the supply of mortgages is being rationed. A lot of non-price rationing is going on.
I've heard that. I think it's true. I mean, I've talked to mortgage brokers and real estate folks, and they do say it's very hard to get a mortgage despite the fact that the rates are really low. And you'd think everybody would want to at that rate. Then why you ask the question then is, why are the rates so low?
Well, the rates are so low is because the Fed has stepped in with this Operation Twist, and they're buying on the long end.
Well, but the other argument you're saying is that it's true that at the low price, there are a lot of people who want the money. They're just, for non-price reasons, they're not being allowed to get it.
Right.
There are these.
One of my friends in Baltimore, he'd applied for a mortgage, and he was in a position to move from the suburbs down to into the inner city, an apartment, and he applied, and the problem is the apartment was in an old apartment building, and there weren't any comparable sales
for the assessment.
And as a result of there not being comparable sales in the area, he could not get a mortgage. And this went right up to the day that the closing was supposed to occur. He wanted to move, his wife wanted to move, all the rest of it. And so, to tell you how risky this guy was, he had enough money in the bank. He just paid cash.
Yeah.
He just closed. He closed. He didn't want to miss the closing. He wanted the apartment. But the bank led him on until literally the 2 days before the closing. They finally flipped the red flag up on him. And the reason they did is because of the requirements of Fannie Mae and Freddie Mac. They required comparable sales for valuation, and the bank itself wanted to unload those mortgages on either Freddie or Fannie. I can't remember which one right now. And so that was the thing that queered it. Now, this is a non-price rationing kind of thing getting thrown into the picture, you see.
Yeah, no, I've heard that too. I invite you to be a guest on EconTalk to talk about Iran, because you'd written something very provocative on that. And I started off with our discussion of hyperinflation to get to that. And we have now made a very long 40-minute detour into the United States situation, which I'm very grateful for. But I'd like to talk in our closing minutes about Iran, because it's an example of hyperinflation, and it'll bring us maybe full circle. You argue that Iran is experiencing a hyperinflation of about 70% a month. The 50 being the benchmark. How do you know that? You're I think the only person who's noticed. People have noticed there's inflation, but you claim to measure it. How do you measure that, and why is it happening?
Well, the way you do this, Russ, is the way that I did it for Zimbabwe. You see, Zimbabwe, they stopped in June of 2008 actually reporting any kind of hyperinflation, any inflation numbers. But the one thing that was going on, there was a black market in the currency. And if you know the change in the value of a local currency vis-a-vis the U.S. dollar, then you can come back and impose what's called purchasing power parity, and make a calculation and easily determine what the rate of hyperinflation is.
A rough guess.
So that's the mechanism. In other words, there's one free market price in Iran, and that's the black market rate. I've got good information on what the black market rate is. So
how do you get that?
I can look at the changes in that free market price, which is an objective measure of value. And from that, I can then make a calculation about the implied inflation rate that's facing the Iranians.
How do you
those are the steps. I mean, it's just a two-step process.
How do you get the black market rates, though? Where did those come from?
Well, there are various sources. The one that's been that I've been using, the Association of Exchange Rates in Iran has been reporting these. Now, once I detected hyperinflation and published that, they shut down all the websites, and I couldn't get this information for a few days. Now I have a way of obtaining it, and I've got a good time series on what the black market rate is. Actually, they have a multiple exchange rate. So the official rate is 12,260 rial to the dollar, and then that's for a couple of categories of items, actually two, medicines and high priority items. You get a very good rate if you qualify on that, and you get that at the central bank. And then there's another rate of about 25,400 that you get through licensed dealers, and that's kind of a control rate too. And then there's a black market rate that's free, and so you basically have three prices for the same thing in Iran, and of course all the distortions that come with that kind of multiple exchange rate system they have.
So why are they experiencing hyperinflation?
Well, one reason, hyperinflation, you mentioned very early in the show that it always is ultimately a monetary phenomenon. So there have been very rapid increases in the money supply since 2010 in Iran. But in addition to that, you've had kind of what's kind of akin to bank runs in currency markets, and that is you have kind of panic selling of reals every once in a while. Or to think about it in a different way, the demand for reals just collapses. Everyone wants to get out of the real and get into gold or U.S. dollars because they anticipate bad times down the road. I mean, maybe they anticipate that the black market will be totally shut down, and it'll be very, very, very hard to exchange any currency. So maybe they want to get out for that reason. It's an expectations thing. The people on the street expect the real to decline in terms of its purchasing power, and they want to get something that's going to retain purchasing power. And from time to time, you get these big plunges in the exchange rate. And when you get the big plunges that they've experienced in September and October, of course, that leads to the implied inflation rate being very high. And then I can go back and just look at the press, and I can look at the price of a key commodity, chicken. And it matches up almost perfectly with the calculations I'm making from these, going from the black market exchange rate to the implied inflation rate. So I've done this with a number of countries. As I say, I've studied all these 57 episodes of hyperinflation. So the analysis works very well, and we had, by the way, the Weimar Republic, the place where this approach of going from the exchange rate to implied inflation rates through using purchasing power parity, actually it was Jacob Frankel, distinguished economist, who did one of the classic studies on this, and Frankel published in the Scandinavian Journal of Economics back in 1976 something called a monetary approach to the exchange rate, doctrinal aspects and empirical evidence, and that was all about the German case, where he just clarified the whole picture and validated this approach that I've summarized to you.
So, for our non-technical audience, purchasing power parity is exploiting the fact that goods of similar quality have to sell for similar prices across the world if they're tradable.
Yes,
and that's what you're exploiting when you try to.
Yep, exactly.
Do the sanctions that the United States and Europe and others have put on Iranian financial transactions, is that part of their hyperinflation?
Well, that's part of that's part of the panic selling kind of thing, and the collapse in the demand for the real. The sanctions come in through that door, and changing people's expectations in Iran and motivating them to try to unload what they think will be a depreciating real and getting something that's more solid. But that's on the one hand. Now, on the other hand, you have to realize the history of sanctions has usually been counterproductive. Usually sanctions, when they're imposed, tend to keep your enemy in power rather than get them out and force a regime change.
I think they're mainly for the home country.
And the thing that's concerning to me about sanctions in Iran is that not only can they be counterproductive, but they can be outright dangerous, because the Iranians control the Strait of Hormuz. And if the sanctions get tighter and tighter and tighter, and any oil can't be sold by the Iranians, they have virtually nothing to lose by shutting down the strait. Now, if they did that, 35% of the world's crude oil comes through the strait, and 20% of the liquefied natural gas in the world comes through the strait. So the mullahs, in short, have an ace up their sleeve, and we don't want them to ever play it. We don't want the strait to be shut.
Well, I think that
we really would have an economic mess on our hands if we had all of a sudden the 35% of the world's crude being cut off and 20% of the LNG.
Well, I think we know how that ends up.
Yes,
they don't end up controlling the straits, but that's war and other.
Well, I think what you end up with then, Russ, is unless we can figure out some kind of diplomatic solution to the Iranian problem, we simply have something shaping up that will have either a horrible end or a horror without end, one of the two.
Well, let's move to a cheerier conclusion. You said you've been involved personally in a lot of the hyperinflations, almost 20% of all of the hyperinflations in history. How do you end them? What happened? What's the end game? I'm sure there are different ones, but have you been called in to find some attractive end games for countries that have lost control of their currency like that?
Well, one is Zimbabwe, 2008. Now that was not a government proactive policy. Mugabe was a president; he still is president. And what happened is there was a spontaneous dollarization where people just stopped refusing to use the Zimbabwe dollar, started using the U.S. dollar and a few other currencies. And that forced the government in Zimbabwe to abandon eventually the Zimbabwe dollar, even for fiscal purposes. And as a result, they officially dollarized Zimbabwe in 2009. So one way is spontaneous dollarization, which leads to official dollarization, or if the government is proactive, they would just officially dollarize and use some foreign currency. Now, that's one approach. The second approach, the one that I've been involved most with, is the currency board system. And the currency board system in Bulgaria, for example, I was President Stoyanov's advisor in 1997, And in February of 1997, the monthly inflation rate was 242% in Bulgaria, so they were hyperinflating well over the 50% benchmark. In July, on July 1st, we installed a currency board, and the currency board issued Bulgarian lev. The lev were backed 100% with Deutschmark reserves, and they were allowed to trade an absolutely fixed exchange rate with the Deutschmark and with full convertibility and free trade. So in that case, the lev just became a clone of the Deutschmark, and the hyperinflation, it stopped in a day. And,
so the currency,
in fact, within 30 days, the interest rates in Bulgaria were down to single digits, high single digits.
The currency board's a way for the government to regain credibility by gathering those reserves, right?
Well, by promising to only issue a currency if there's 100% reserve backing for that currency with an anchor currency, and the other rule is that locally issued money will trade at an absolutely fixed exchange rate with the anchor currency. And if it's a credible program that they put in, and bang, you've solved the problem, because the local currency becomes the anchor currency.
Well, I know you've written a lot on that. We'll put a link up to some of that, because it's an interesting idea. My guest today has been Steve Hanke. Steve, thanks for being part of EconTalk.
Good to be with you, Russ. Thank you for having me.
This is EconTalk, part of the Library of Economics and Liberty. For more EconTalk, go to econtalk.org, where you can also comment on today's podcast and find links and readings related to today's conversation. The sound engineer for EconTalk is Rich Goyette. I'm your host, Russ Roberts. Thanks for listening. Talk to you on Monday.